All right, welcome to our monthly Ranch Right webinar. We are here to talk about our financials, and this week we are a small crowd, but we are going to talk about the risks of debt. The last couple months we have talked, or last couple months we've talked about the impact of debt, and we've generally talked about positive effects, right? Debt impact and how it can help you increase your gross product. Now I want to talk specifically about how debt adds specific risks to your business and how to think about those. Can you see my screen, Eric?
Yeah.
All right, great. All right, so debt is sometimes called leverage. And one of the reasons that's important is because I think it's the perfect type of thing. Leverage means there's a bit of a magnifier effect. So good or bad, that effect is magnified when we add debt into a business. We've talked about examples where, and there's a great example in the Ranching for Profit school book where, it demonstrates the fact that as you add debt, if you add profit, that tends to increase your profitability. And as you go, if your profit is negative, it will further reduce your profitability. But the important thing I want to cover today is that there's more to it than just that. And this concept of risk and how to quantify risk is a very difficult thing to do. I shouldn't say it's difficult. It seems difficult, but it's actually not that hard to do. That's the reason why we're having this webinar. We try not to cover terribly difficult topics because I don't understand them if they're difficult. One of the things that this idea of risk, we want to make sure that risk is sometimes hard to put into dollar terms, and it is sometimes hard to imagine. And sometimes we have to sort of channel our inner black hat type person. What could go wrong? What things could happen that would make this not work? Sometimes it can be hard to challenge us on our, kind of on our own ideas. The first thing I want to talk about, we're going to talk about all three of these in order, is I want to talk about flexibility. I want to talk about the value of an underlying asset, and I want to talk about actually making the payments, because in my mind, those are the three main sources of risk. When we talk about flexibility, the important thing about debt is that we effectively lock in our future when we commit to debt. Debt is paying in the future for things that happened in the past, or at least even if they didn't happen, commitments that were made in the past. An ordinary expense, for example, is different because if I buy something today, if I just pay for it, I incur the cost and receive whatever I'm buying in return, whether that's a service or a product. Payment terms with debt can be very varied, but they are usually fixed. And so, for example, when I take on a mortgage, I am agreeing to a set of rules by which I will repay that mortgage, which may span the next 40 years. There are things like income-based repayment, which we see like in student loans and that sort of thing, which can be used to help alleviate some of the flexibility problem. But most things we pay either in monthly or annual payments. The payment is fixed, it's a fixed amount, and it is due at a particular date, kind of no matter what happens. So if it's March 30th, 2020, and the world's just shut down because of COVID, landlord doesn't really care. Your rent's due at the first of the month, and so off we go. Sometimes we structure debt with balloon payments or uneven or variable payments so that we may have a reduced payment for like an introductory period and then a large payment after a period of time. And then sometimes I'm going to just jump down to like variable rate interest. Sometimes we can do things where we have a fixed interest rate for a period of time and then the rate adjusts after, let's say, an initial 5-year period. The way the interest is structured can affect the repayment program. And then finally, we have things like early payment penalties, which are one of the things I think I like the least in the world of debt. That is effectively saying, and it's usually used by loans and lenders that have particularly high interest rates and onerous terms, but if you pay it off early, you are going to pay a penalty. So we see cases now where we have someone will loan to a high risk borrower. They'll do it at maybe 5 points above sort of prime, and then there will be a bunch of fees attached with it and an early payment penalty. And those are terms I really don't like. But sometimes we need it, and sometimes if we're in a particular spot, it may be that is the loan we take. And so when we make that commitment, we are committed and we go forward. The problem with this lack of flexibility or sort of locking in the future is, what happens if the future changes? And of course, I know none of you can imagine a scenario where the future does actually change and, things are different than they are today. But I am old enough to have seen a few times where that has happened. And my good friend, Fred Provenza, and my mentor for graduate school like to say that the only constant in life is change. And so when we lock in like a payment on a mortgage, we are effectively agreeing that no matter what happens in the world, we are going to continue making that payment at that dollar amount. Of course, we can refinance at different times. So, I mean, there are opportunities to make those changes, but effectively a loan assumes that we're not going to do that. All right, the second big risk of debt is the change in the underlying asset value. So I want to make a bit of a pivot. This is a different segment of this talk. The important thing here is that often when we buy an asset and we finance it, there is a value associated with that asset. So if we were 100% financed, for example, on a stocker calf, we might be able to go buy a stocker calf right now for $1,500. We borrow $1,500 against that. We have the stocker calf under our control, and we have a line of credit or a note to the bank that we have to pay back. The thing we know in all of these things is that all assets, and if there's an exception to that, I'd be curious, but all assets change in value, right? None of them are constant. But there is difference in the volatility. So if you look at the price of a live laying hen, right, they change, but not that much. And even if they change by a significant percentage, it's not a big dollar amount. Lambs would be similar, right? A 50-pound lamb, for example. Yeah, there's variation, but it's not thousands of dollars of variation. Same, stocker calves would be more volatile, if you will, but again, there's some range of reasonable, and then there's some range of unreasonable. Cows pick up real estate. We assume as we get up to the level of things like real estate that the values become fairly stable. But even the most stable assets, as we saw in 2008, they can experience some pretty big swings in value. It's not as common as it is for stocker cattle or barrels of oil or wheat, as an example. But it is still there and something we need to be prepared for. And 2008 has been a fast forgotten lesson, I think, of the fact that even the old adage that my grandfather used to say of real estate never goes down in value. While that's kind of true on the right time horizon, it is not necessarily true at any given time. An important concept in this asset value comparison to our debt topic, though, is the concept of being underwater. And if things go bad in the market and our asset really decline, our leveraged asset really goes down in value, we are called underwater when the asset's value is actually less than the loan balance. So the steer I mentioned that I bought for $1,500 and I got a note for $1,500. If there's a hiccup in the market and the market drops 20%, well, suddenly now I have an asset that is worth less than the loan payment amount. I really want to not be underwater. Being underwater is a bad thing in real life if you're not there sort of your own free will and able to get out. But being underwater financially is a very, very risky position. You can stay there for a little while, but it's not a good place to linger. The biggest thing about trying not to be underwater is, of course, the first thing is your bank, it always seems, is less likely to call your note. That's not 100%. That's a probabilistic thing, but they generally don't like to do that if they don't have to. The other thing is, if your bank did call the note and you needed to get out of it, you could actually most likely sell the asset, pay off the loan, and have no remaining balance. So you're kind of come out of the deal even. That might significantly reduce your profitability, but it sort of keeps you most likely able to live to play another day, which is kind of what we always want to do when things are going bad. Sometimes that's a good backstop position. The problem with being underwater is that, frankly, that increases the likelihood that the bank is going to call the note. If we do have to get out of that position, of course, we sell the asset and we can't pay off the loan. So remember, the loan balance is bigger than what the underlying asset is worth. Okay. And in order to get ourselves out of that situation, it means we have to go beg, borrow, or steal money from some other pool or other, resource place to then get ourselves out of our obligation to the bank, or otherwise we face fairly significant, legal financial ramifications. And of course, our ability to play in the future is reduced. Any questions to this point? Awesome. Thank you, Eric. Oh, Cole, you're here too. Feel free to chime in, Cole. We're thinly populated today.
I feel like you're in academic terms, you're kind of describing my experience this summer with my negative with my negative equity position with my pickup truck. So I now have words to my feelings of hurt, John. Thank you.
Oh, you're so welcome. So how do you have a negative equity position in your pickup truck, if we can use this as an example?
Well, I bought the pickup truck at the worst possible time to buy a pickup truck.
When equipment prices were high a couple years ago.
Yeah, high to COVID. You got to do what you got to do. And then I traded that truck in just a few months ago, right? And vehicle prices here in Canada, at least, have tanked, right? Which is a good thing on the purchase. Not so much when you're trading in a vehicle.
Yep.
So I owed more money on that vehicle than what I got for it on the trade-in value.
Yeah. Didn't the transmission go out on that truck or something like that too?
No, it was about to. So that's why I needed.
That's why it had to move, huh?
Yeah.
Okay. Now, when we're managing the risk of the underlying asset value changing, what we want to really do is look at our degree of leverage. The more leveraged they are, I used 100% leveraged example earlier. The more leveraged we are, the more sensitive we are to a negative change in the asset value, right? So if the asset value goes, I hope it goes kind of without saying that if the asset value goes up, we're not at a lot of risk, right? If it's only when the asset value goes down relative to our purchase price that we have risk there. And the reason the purchase price is important here, we try never to look back, but the purchase price is important because that is what determines the amount of leverage or the amount we have borrowed against that asset. So often we're looking at either loan to asset value, debt to equity ratio, or debt to asset value. These are all numbers that sort of give us an approximation of where we stand relative to our borrowing and with the value of the things we own. Loan to asset, as an example, if I use the $1,500 steer and a $1,500 loan, that would be a loan to asset value of 1. Very, very risky position in my mind because the market doesn't have to move but 1 penny down, and now I have negative equity. Debt to equity would be similar but expressed differently. But again, same thing. We're looking often, loan to asset value for 50-50 or 1-to-1, however you want to say that. Debt to equity, same thing. And then debt to asset would be a number that is usually a fraction. So we talk about that. If I am 50% financed on that, then that would sort of express itself numerically. But these are all the things we want to make sure we understand. And what those numbers mean. Different banks like different numbers, and there are even a few others that they like. You kind of want to just learn the language of your banker. What is he familiar with? This is kind of like the AUMs or animal days type debate. Like, just know what language your culture likes and then proceed appropriately. But we have the opportunity to manage that relative to what we expect for the swings in the underlying value. Now, I'm going to take a mortgage as an example. If you qualify, you can often get a 98, 99, 100% mortgage. And one of the reasons is because, and sometimes you can get 110%. But one of the reasons is because over a 30-year term, which is usually the period of a mortgage, real estate is expected to go up. It's considered a fairly safe investment. It's considered fairly stable. Most people will pay their mortgage even if they're underwater because that also happens to be where their family lives. So you can weather some difficult times there because as long as you can make the payment, it doesn't really matter what the debt to equity ratio is. your family's still going to need a place to live. So if you are living there, that sort of helps the bank feel assured that you're going to make the payments. In the livestock market and the commodity markets in general, we see, and I wouldn't say frequently, but with some regularity, we see market swings in the range of 70%. I think wheat in 10 or 11 did a like 68% swing in about a 6-month period. Cattle did well over 50% and on the order of 70% in about a 6-month period in 2015. And it doesn't happen every year. We rarely see 70% in any particular year. But if you look over a 10-year period, that, when we talk about the cattle cycle, that is often how it happens. It doesn't proceed up nice and smoothly and down nice and smoothly. It bumps around at one level for years and then makes a sudden big change. And then it bumps around at that level for years and then makes a sudden big change. We saw about a doubling in prices last year in about a 6 to 9 month period. And like I say, in 2015, we saw a 70% drop in about a 6 to 9 month period. So those are not regular events, but I would not call them unexpected, and I would definitely not call them black swans. I'm pretty strict about black swans. A black swan has to be something that nobody has ever heard of before. At this point, a worldwide pandemic is not a black swan because we've all heard of one. We may not be prepared for one, but we've heard of it. When the term black swan first came to be, black swans, I believe, live in Australia. Everywhere else in the world, swans are white. No one had ever seen a black swan. The first person that saw a black swan saw something that nobody else had even ever imagined had. Thank you very much. When we talk about things like market shocks, about big price drops in commodities, about changes in interest rates, worldwide pandemics, outbreaks of things like swine fever, those are no longer black swans because, again, we've seen something similar to them. And because of that, I'd argue that we ought to plan accordingly. The way we plan in this particular case is we manage our loan to asset value so that we are reasonably prepared not to be underwater. Now, does that mean if we see 70%, you always want to have only a 30% debt to equity ratio? Like, nah, I don't think that's quite right. But through a combination of things, you want to make sure that you are prepared for that big of a swing at any particular time. We are it's August of 24 right now. We're in a relatively high market period. The market has dropped fairly significantly over the last few weeks and even months. And I don't know that we're in a big drop right now, but it's not unreasonable to think that a big drop could happen. When heifer calf prices are down under $600 a head, probably a lot less likely that they're going to take a 70% drop than when they're at $2,200 a head. But again, that's not, we don't want to do any future casting there. All right, does that make sense? Any questions on asset value and how it relates to borrowing? The longer the term of your borrowing, I will say that the more it decreases flexibility, but the more it probably increases risk tolerance, because generally that means that the payment itself is actually lower, but the term is longer. So you have more opportunities for bad things to happen, but you also have maybe more freeboard, if you will, more room for positive cash flow. All right, no questions on that. We'll keep rolling. Now we want to talk about payment risk. This is the third risk, if you will, of taking on debt. And it is literally the question here is, can we make the payment? Debt, important to know, we've talked about this a number of times in webinars, is paid out of net income or out of after-tax profit, right? And I don't necessarily mean that you pay taxes first and then you pay debt. I don't mean that that's the sequence. I just mean that financially, that's how it is calculated, that's how it is paid. Paying off debt does not reduce your taxes, for example. Paying interest is an expense, it will, but the principal does not. But we pay that out of profit or net income the same way we pay our taxes, the same way we pay fixed asset replacement, the same way we invest in the growth of our business, et cetera. And ultimately that means that we can have a profitable business that cannot cash flow because it cannot pay its debt. I just looked at a case the other day. I'm going to anonymize this just a little, where we had a really healthy $70,000 profit. We'd all like to have a little side business that generated 70,000 in profit. For the size of the business, great number. I looked at another business same day, it generated $486,000 profit. Fantastic, good stuff. The problem with the $70,000 business is it had a $200,000 annual payment, which meant that they were $130,000 short. Now, net income and cash are not the same thing, but at some point they kind of catch up to each other. But the $480,000 business, net income business that at $100,000 annual payment is in a much better position to cover that debt. So we talk a lot about debt coverage. We've done a webinar or two on this already. I've done some continuing ed in different forums about this. But this essentially is how much will our net income cover our debt? We calculate it as a ratio or a percentage, and we're looking for a debt coverage ratio of 2 or 200%, depending on how you want to express that. And all we do is we take our net income number and we divide it by the total long-term debt payments. So it's principal and interest. It doesn't matter which is which. It just means the whole payment. So for example, if I have $100,000 in net income, I can comfortably service $50,000 in long-term debt payments. Okay, now when we look at buying the neighbor's place, when we look at investing in tractors or machinery or cattle, and we are doing that with leverage, we look at the payment and we want to compare that to our net income or to our profitability. We want to make sure we have enough money left over in the business, enough economic value created to cover that debt. The reason we use 2 is because that accounts for the bleep happens type moments. We want some padding. We want some risk tolerance. If we have a debt coverage ratio of 2 and we have a drought, we're probably still going to be able to make the payments. If we have a debt coverage of 1.001 and we get an outbreak of mycoplasma in our herd, suddenly now we can't make the payments. We are trying to buy some padding by looking carefully at our debt coverage ratio. If we cannot cover our long-term debt payments with our net income, then that money has to come from somewhere. It almost always will reduce our working capital. It will deplete our cash reserves. And this gives some real credence to the importance of a rainy day fund. The rainy day fund gives us a buffer against uncertainty. We live in a very uncertain, market. We live in uncertain sort of environmental conditions. We live in uncertain animal performance conditions. This rainy day fund, I think, is especially critical when we take on new debt. The first few years of a new investment are the highest risk. When you buy a section from the neighbor, there is likely something you don't know. When you buy a big set of cows that from, somewhere else, there's something you don't know that you're going to find out later. And rarely are these types of surprises, good surprises. It happens like, man, that just turned out way better than I thought. Like, yeah, sometimes, but most of the time, the surprises that come, oh, the irrigation well that came with that place, the casing was, starting to cave in, or, oh, the motor on it had way more hours than we thought it did, or, et cetera, et cetera, et cetera. These things happen. What we really want to do whenever we take the especially long-term debt on is have a plan for things not going well, have a cash reserve. In many cases, when we're taking on long-term debt, we are required to make a down payment of some kind. My preference is, while I'm not against down payment, but I want to make sure I have enough for the down payment plus extra. So if I have to make a 2% down payment, I probably want to have 4%, make the 2% down payment, and then have another chunk that's going to allow me to sort of cope with the unexpected. I want to reemphasize this very important point that's come up in my life a lot recently in a number of discussions I've had in public forums. Most businesses fail not because they're not profitable, but because they do not cash flow. Cash flow is a huge risk, especially in a new business or a business undergoing any kind of transition. So when you make a major change in your business, like you convert from a dairy to a cow-calf operation, when you convert, from a farm to a regenerative grazing operation, when you convert from cow-calf to stockers or stockers to sheep or whatever, those transition points, just like weaning, just like shipping, just like sales for cattle, those are all particular, sort of transformation or transition points where additional risk always happens. Can't emphasize enough, it's a great time to have extra working capital, to have extra cash, to have extra access to resources that will allow yourself to get yourself out of trouble. The reason I say that in this context is because, again, debt for most of us has a massive impact on our actual cash flow. If you own a ranch and have a mortgage, that is probably one of the biggest impacts on your cash flow in the whole operation. When we have no debt, we have plenty of other things that affect our cash flow, but it's not that. So it makes our operation a little simpler to run, but it doesn't necessarily make it more profitable. I want to make sure that some of us are very debt averse, and I don't want to downplay that too much. I'm not 100% debt averse, but I do want to make sure we all understand that it does add risk, and the specifics are very, very important. And we have got to have a plan for things not going well. When I first started out in business on my own, my father gave me some good advice that I repeat regularly. And it was as followed, and I thought he was crazy at the time. I am now the age my father was when he gave me that advice, and it's good advice. I assure you, it has stood up 20 plus years of advice giving. He asked me to run a model where effectively I increased my expenses by 25%. I decreased my income by 25%, and then I doubled the amount of time it took me to get payment from customers. And as it turned out, I did all of those in my model, and it still worked, but barely. And he said, okay, that just make the adjustments so that it works at that level, and then see what happens. Well, as it turns out, I made about $6 at the end of the first year, because funny enough, my income was reduced by about 25%, and my expenses were over my estimate by about 25%. And it took me a long time to get paid. It all worked out. Nobody went broke in that process. And the second year of the business was frankly wildly successful because we were able to make the alterations we needed to based on the first year. But that sort of overly conservative, what I thought at the time was an overly conservative approach, really added a ton of value. And that's what I mean by having a plan for when things don't go well. One other thing I want to add that Wally Olson always adds is that, and I think I had a comment on this on one slide that I may not have mentioned, which is profit margin also helps buffer against risk. If you have and that 25% example sort of demonstrates that. If you have a high enough profit margin and things don't go quite the way you expected, it helps. It makes a huge difference, because if I plan for a 40% profit margin and I get half of it, I'm still in great shape. If I get a quarter of it, I'm still in great shape. If I miss it by 3/4, by 90%, I'm still in good shape. I may not be very happy with the outcome, but again, I can live to play another day and make better decisions as I go forward. So with that, I want to thank Wally and Walter, and of course, Ranching for Profit, for helping us sort of refine these ideas and get them out to people. We have had a wonderful time. Also, I need to add Sarah Delavan onto this list. A wonderful time discussing some of these things in some recent forums that have been just a lot of fun to explore the ideas more. And I am very, very thankful to all of those of you who come and attend these things on a regular basis. So with that, we'll open it up for questions and then wrap up. Cole, Eric, Ben, Derek, any questions? You're on mute, but it looks like the answer is no. Okay. Awesome.
Yeah, that's correct.
Ben. No? The mute went off. Was that you, Eric, or him?
I think it was me.
Oh, okay. Go ahead. What were you gonna say?
No, I was gonna say no questions. You
Great.
read my lips, right?
Okay. That sounds great. Since I
Well,
can't hear.
okay, well, no. I'd be failing my job if I didn't ask you a question as the question man. Um, what kind of insight can you offer in terms of risk when we compare fixed rates loan products to variable rate loan products, right? We're trading one form of risk for another,
Mhm.
sort of, I think. Any thoughts on that?
Yeah, I do. And like the leverage deal, the percent leverage, um, I would say that it really depends where you're at. When we were at 3.5% prime rate, there was a risk that that would go up, and there was a risk it would go down. And I would argue they were very asymmetric. If we're at an 18% interest rate, which we are not at this point, right? We're at 8.5% prime. At 8.5, I would say there is a risk it goes up or it goes down, right? We could kind of split the difference. Over a 30-year period, I'm sure there's a way where it, works out about the same, right? But the other thing that really matters is how much stability do you need in order to be able to plan effectively? So you might
Right.
lock in a high interest rate, but that interest rate comes with certainty, and that certainty may have more value to you than the opportunity created by the rate going down. And then the other thing I always like to imagine is that with a fixed rate, it is always pretty easy to refinance. Sometimes with a variable rate, it can be more difficult. We saw cases where variable rate mortgages came to their, balloon adjustment period right after interest rates spiked. And so that meant that the mortgage payment went up by 50% in 1 month and then stayed there. So if you have a, $10,000 mortgage payment and your rate adjusted in 22, is that when rates went way up? When 20, yeah, 22 or 23, either one, your interest rate basically doubled then when your rate adjustment happened. That is a huge impact on your payment. So for long-term debt, I'm a fan of the fixed rate, and mostly because right now I feel like we live in a relatively low rate environment. Even at 8.5%, I think there is a risk that that rate goes up, which makes my repayment ability a lot harder. And there is a small risk it goes down. And I feel like it's easier to adjust to refinance when the rate goes down than when the rate goes up.
Right. That makes sense.
Okay. Awesome. Any other questions?
No, sir.
Thanks. Question Man is an unofficial title, which I'm glad you've adopted. So it works out great.
There you go.
Cool. All right. Well, I'm going to stop the recording. Thank you all for coming. I appreciate you listening. If you have questions, please get a hold of us. If you haven't heard already, the Ranchonomics podcast is out on iTunes and Spotify and a few other places where podcasts are listed. We do this webinar every third Thursday of the month. Derek said it was on Instagram. That's where he got it. So it must have gone out on social media. And we usually, if you are on our email list, we will send that to you, and they are recorded and will be posted on the website and available through our YouTube channel at ranchrightllc.com or on YouTube under our Ranch Right LLC channel. So thank you all for joining us, and we will talk soon.